Welcome to Profile 101. I am JJ. It's wonderful to meet you. We've got a bunch of new folks in the room. And what we like to do is we like to use these market profile charts to reveal a structure, right? To organize price and time and volume, to tell us what actually is going on in a market and how we can benefit from it. And just really quick, how many folks here have never seen these charts at all? Anyone? That's cool. That's cool. Good. Okay. Beautiful. All right. That's not a problem. We don't do a sort of step-by-step approach, but market profile is something that it's not that it's hard to learn, but I'm just trying to figure out how to properly explain it to you guys, right? Is this slide in the market profile basics tabs? I do believe it's in there somewhere, Slot. It should be. If it's not, I'll make sure it gets put in. But this was done quite some time ago, so I'm assuming it is. Okay. This is just a basic 101 how to look at market profile. So I'll start from the beginning. Market profile, all it is a system of charting that allows you to look inside a candle, right? Oh, thanks. What we do is we take the market profile, and all a market profile really is a half-hour candle chart with a ton of information in it, okay? So the textbook explanation of all this stuff is that it's a distribution curve, right? If you remember stats class, in stats class in high school, you took a bell curve, right? And it would have a distribution. So you would have the fat part of the curve is where 70% of the action takes place. We call that the value area. And there's price above and below value. And the whole reasoning behind this is we take price on one side, time on the other, and we look to see where the majority of the action takes place, because stats people say something called a reversion to the mean, which means when price gets away from the middle, it will return back to a place where, as Dalton says, two-sided trade can occur. Okay. Now that's the sort of scholastic view of market profile. Okay. What it's showing is it's showing you where the distribution of prices happened, or I'd like to say where the distribution of all the transactions, like Wall sells a contract, Shelley buys a contract, that is a transaction which is recorded. Okay. And so every half hour profile, every half hour bar is represented by a letter. All right. So Wall of Stone, the market opens at 9:30, right? So the market opens at that first half hour bar is called A period. So wherever price transacts in that first half hour is recorded. So in this book here, this little star, the red star, that's the open of the market, right? So the market opens, goes down, goes up, the next period opens, and you'll note that the next period, the next half hour bar, can't take out the first one to the lows. That would indicate that the market has run out of supply and it's a long, right? So how we look at this to trade this, I'll just do this really, really quickly, right? What we look at is, so the market opens, and say you wait for that next half hour. You want to take a long. Well, what you're going to do is you're going to get long somewhere here, right? Because, I mean, let's face it, you most probably aren't going to get the actual B low. But say if you execute somewhere in this range and you get long, where's your stop going to be? Your stop is going to be just under that B low. And this is what's called a structural stop. Okay? So the profile tells you where to take the trade and where to put your risk. See, because your stop is what they call a structural stop. Now, if the market's choppy, you can use the A low as your stop. You know, if it's very volatile and choppy and you're a larger trader, you can take that kind of movement, you can put your stop here. If it's a calm market, you can get away with the stop here. So your entry, your risk, this is what we call a structural stop. And where would you be wanting to get out of this trade? Well, I'd be looking at the A high. So I'd be going maybe a tick or two below that A high, and that would be my target. Now, this is just an example if I was trading one contract. So does that make sense to everybody how I saw this trade and how I took this trade? I thought I'd always use a trade example. Okay, cool, cool, right? Now, why is this important? Because if the market comes down and it breaks through this stop, I don't want to be in the trade, right? If it breaks this structure or that structure, it's telling me that there's sellers in the market. If the market gets down here and can't take out that A low, it's telling me, hey, JJ, the selling's dried up and the market's going to turn and go back up. So that's why we use what we call structure. This is our structural exit because it's close to the open. Our structural stop is the B low. And now my structural exit is going to be just a tick or two underneath the A high. Now, if I was trading two contracts, I'd sell one here and I'd sell my other one probably right here because that's where the stops are. Market profile can also tell us where the stops are. So if a market is ripping along and it can't take out that A high, it's out of juice and it's going to turn right around and come back down. So you could use that area to tell you how much strength the market has. If the market can run the A high and break through, you can sell one of your contracts here and then scale out of your position as the market goes higher because we sell into strength. Does everybody understand that? I'm just going to pause for a second and make sure everybody understands that. Right? So basically, they're just half-hour bars that we get to open up. Right? Now, this is a pretty simple example. This is just market profile. Right? Sure, no problem. Okay. Now, when we look at my charts, they're going to look like this. Oops. So this is a market profile with a volume profile next to it. This is the market profile by itself. This is just the structure. Right? So when you look at a market profile, does each letter make the start? Yeah. Where the period starts is going to be a little yellow letter. So where the market opens, my market profile charts, that letter A is orange because that's 9:30 in the morning. So it's 9:30 to 10, right? And then B period is 10 to 10:30. And B period opens here. C period opened up here. D period opened here. right? And so on, right? So this profile has a shape to it, right? At the top and the bottom of these profiles, we have something called excess, which are letters by themselves showing that not much time was spent at these price levels. You see how there was a lot of time spent here? This is the time point of control. And we spent 12 half-hour periods at this price. You guys still with me? Okay. This is the value area, this blue area. That's where 70% of the volume has traded in this distribution. Okay. So when we have these profiles, the market will open in A period, right? As the market trades and the structure is built out, the middle of the profile will be shown by this little white letter. And in Chicago, they call it halfback. It's just the middle, right? It's just the top, the bottom, the middle, right? This is the time point of control. This is where the most time has been spent. So sometimes I'll say, you know what? We're 12 wide at a certain price. And that means we've spent 12 half-hour periods or 6 hours at that price. Everybody still with me here? Cool. Now, when you put the volume point of control next to it, it shows you how many contracts traded at every single price point. So here we had 54 contracts, 130, 240, 312, 398. Do you guys notice that as I'm going up, the number is increasing? Or in this case, as the market came down, the number of contracts decreased. The whole session, Susan. Halfback is just the middle of the entire session. No problem. It's a term that you don't really hear that often. And what we use that middle is sometimes the price will go up and come back, and oftentimes it'll stop and pause at the middle of the range. And that'll tell us what type of trading is in the market. So what these profiles do is they tell us a lot of information about who's in the market, what their intentions are, what they're going to do with the market, and how we should trade so we swim next to the shark instead of into the shark's mouth, okay? Because when it comes down to it, these markets are traded and sort of the price is moved by large traders, right? Those large traders comprise of people who are wholesalers, right? So these are the institutional players in these markets, right? And you really have to understand who they are. You don't have to be an expert at it, but you have to understand that there is a wholesale element to a market. There are people who buy from us and sell to us when nobody else will. They are called liquidity providers, or what we call wholesale market makers. Okay? They get their order flow from the brokerage firm. So they'll go to our brokerage firm, say you trade at Interactive Brokers. Well, Interactive Brokers will sell their futures order flow to a company such as Citadel, and they pay to get that order flow, and that's how they make their money, by providing us liquidity. Then there are size proprietary firms and pools. These are people who have, say, 200 million, 300 million, $500 million of speculative money that they trade short time frames with. Okay? So these two players here are the ones that have been moving the price on an intraday basis in the S&P futures for the last 2 years, right? These large and small hedge funds, pension funds, and global investment managers, right? They are less common because what there's two types of money in a market. There's trading money and then there's investment money. These people here represent more investment money. They make an investment, and that investment is for a longer time frame. That's why in market profile books, you will hear these people called the other time frame because they buy and hold for 5 years, 10 years, 20 years, some of them 30 years, right? So they buy a chunk of stock or a product and it goes away for 20 years. It does not get actively traded out. So they're not trading every day. The people who are trading in our market who actually move the price are these two groups of people. What market profile does is it allows us to track the movements of the people who move the price. So now you folks all know that we don't move the market, right? We buy something and hope it goes up, or we sell something short and hope it goes down, right? We don't actually have the power to move the market. So what we need to do is we need to find out the people who are moving the market, what are their intentions? So we can trade with them. Does that make sense? Everybody still with me? Cool. Now, these profile shapes are quite amazing, right? After a while, you'll start to be able to pick things out very, very quickly. And I mean, I always ask this question every time I do one of these. How many people have shorted in the hole, right? Shorted at the bottom of a market only to get stopped out as the price went higher, right? I've done it. Everyone's done it, right? I don't think I'd believe anybody if they say they haven't, right? So if I could tell you or show you really quickly, if I could look at structure in a market and immediately know not to short that market, is that something you'd be interested in? If you could tell within 30 seconds of looking at something, I shouldn't be short, right? Profile will do that. It's called a poor low, right? See, the lows and highs of these things, of these shapes, tell us a lot. When the market goes down like this and leaves just one little tick, you see the number 1? There's just one letter here by itself. In market profile terms, this is called a poor low. It is poor because of the way it looks. Anything less than 2 ticks at the bottom of a profile means that the low is poor. So there's 1 tick, or if you had a double bottom like that, that's a poor low. Now, what does that mean? A poor low means that the selling volume shut off like a switch. Now, why does the selling just shut off like a switch? Well, because we have a market that does not have a lot of supply from outside longer time frame investors who are selling. Those people aren't selling, so therefore there isn't a lot of supply. That's why if you look at the S&P 500, right? That's why you have kooky looking charts like this, right? And every time the market goes down, it rebounds higher than it fell off, right? That's because we don't have any outside supply in this market, right? And that means companies like BlackRock and Fidelity and those kinds of companies aren't selling any stock. So the shape of the profiles, right, and where they are can tell us so much about where the large traders are positioned and what their intentions are. After a while, you'll be able to use the profile to tell you when to trade, when not to trade, right? When to wait for a good setup, when the trading's really not worth you risking your money. Go have a coffee and come back. These charts will tell you an insane amount of information, right? The problem is you've got to spend time with them, right? Everything in this type of charting is a function of screen time. So let's take a quick look, right? It really, really is. And I know I'm kind of being a bit of a salesman here, Sorry, just all my marketing background. But here's the thing, right? This kind of charting, right? While at first it's very odd because you don't see it anywhere, right? I've been in the business 29 years. I've only seen this in one place, right? And if I didn't get into futures trading, I would have never found these guys, right? So what these charts do, right? And there's nothing wrong with candle charts, but profile charts, they kind of give you that extra little bit of information. Now let's take a look at the shapes of these profile charts and what they can tell us. Now, yesterday we had a market that was a trend day up, right? Now, what's a trend day? A trend day is when the first, sort of 4 or 5 half-hour periods are consistently higher, right? So let me just split this right here. And the market opened here. You see that orange little bar right there? Yeah, it's really it's a well-kept secret, right? Have you ever done a 3-month or a 1-year chart to see the next handful of moves? Kind of yes and no. Let me get to you for a second. So let me just finish with this NL and I'll get to your question, okay? So this is what we call a trend day, right? I got to keep it a little simple because we have some new people in the room. So if you can hold your questions until the end, like unless they're like about the profile, like simple stuff, don't let me forget, okay? Because it is a little confusing. Like the first time you see these charts, it's going to feel like you got a Slurpee headache, right? It does kind of hurt the head a little bit, right? Following the questions, we get it. It was only info levels from the profiles. Yeah, I'll go over that. So this is what's called a trend day wall of stone, and this is something that you don't want to short, right? Sometimes the profile will have like a big screaming neon sign saying, "Hey, hey, don't short this. Don't short this. Don't short this." And a lot of people who don't understand this type of charting or have never even seen it, they would have been shorting like crazy. Like we had a guy in our room yesterday, when he was trading this, he shorted this 8 times and got stopped out 8 times because he was shorting a trend day. And what a trend day is where every successive period's low is higher than the previous one. Do you see that? Another way that profile people call this is called one time framing up. Okay. And you'll see this, right? Of course, if you traded candles, you wouldn't even be thinking that it's a trend day. Now, wait, there's more, right? Like the sham wow, but wait, there's more. Hang on a second. Now, if I take this particular profile and I squish it together, you're going to see something else that's telling you, for the love of God, do not short this. And these are these single sets of letters between these distributions. I'll go back and put this on. You see, these are letters. There's that A period, B period. This is what we call single prints. And for a short seller, single prints are the kiss of death on the way up. Because what they're telling us is there's absolutely no supply, right? Trading is all about supply. Nobody will ever tell you this. And for the love of God, I have no idea why people don't tell people this. But trading is all about supply. If there's supply, we can go short. If there's no supply, which means if there is no one around to sell product, whether it's a stock or ES or gold or whatever, if there is no supply, there is no way in hell that price is going to go down. So there's no reason for you to be short if no one is selling anything. Does that make sense? I'm just gonna pause for a minute there. This is one of the most important concepts that a retail trader can grasp, right? If you can quickly tell in a market that there are no sellers, you will not be biased short. What the F am I looking at? Okay, right? So this thing opens here, right? When this is just a half hour time frame, right? When the market gets up to this level here, right? Do you see that A high? I'm just going to make this really big. Do you see the A high here? When the B period gets up here and it takes out that A high, it does something called a stop run. Short sellers have their buy orders here. So the market rips through those buy orders and all of the supply that's available gets quickly bought up. So what happens is you'll have people who have buy orders in here that can't get product. It's like you went to buy like the popular video game at the store and there's nothing for sale. So the guy who got 10 of them walked in and bought 10, he can sell them for whatever you want. So this area here is a short position. No, the product, there's nothing for sale here. Like, the saying, there's nothing for sale in Tuscany. There was product and it got eaten up very quickly by people who were short. And there are people who are still short trying to buy here, but can't get filled. So think of it, there's 1,000 buy orders here, El Raton, and there's not a single seller. The same thing happens at this level, right? So what we have is we have a trend day up where every low is consecutively higher. And then we have these single prints, which is a short position. So this is very interesting. This is the kiss of death to short sellers. Exactly. Del Boca Vista. There's nothing for sale in Del Boca Vista, right? And people are sitting and hammering and shorting and shorting and shorting. And what's going on? The price is just tearing higher, right? We've all done it. I've shorted a trend day. I'll admit it. Before I knew what was going on, I'd go, it's too high. Go sell a few, right? Today there was a little bit of supply, Jojo. It's going to take some time. I'm going to get to that in a second. You're about 2 steps ahead of me, right? So this type of structure that these profiles show that you'd never even think of in a candlestick chart really saves your bacon. Because here's the thing, even if you don't go long, right? Because it's hard to go long these trend days, right? So if you miss the long, that's okay. At least you don't blow up your account trying to short it, right? Just that alone is worth its weight in gold. Because sometimes it's better not to lose money and sit there and not do anything than to lose half of your account shorting something that just is not going down, right? And in this market, how many times have you seen this market rally and it just keeps going and going and going and going, right? And you'll see people shorting it and it's horrifying seeing people short it because they'll be short down here, they'll add, then they'll run out of steam and get bought in, right? And then there goes your account. This kind of structure, once you get to see the hallmarks of a trend day developing, once you see single prints to the upside, they're telling you immediately, for the love of God, do not short this thing, right? It's just going to cause you the most emotional and financial pain you could possibly get. Yes, what you're supposed to do is when the market comes down, right? It goes up. Here, let me just get rid of these arrows for a second. So what we're supposed to do is when C period opens and it comes down and it can't get any lower or into these single prints, we want to get long here. Or we want to get long on the pullbacks instead of shorting them. Does that make sense? Now, wait a minute. It sounds great after the fact and on paper. It's really freaking hard to do when it's happening. Right? I find trading a trend day is hard. Right? Because no, this is one of those structures that does take a little bit of work to be able to, because there's always one guy, oh yeah, I bought a whole bunch here and I wrote it all the way up. Yeah, whatever, right? There's always one of those, right? But what we're supposed to do is if we miss this entry, right, we're supposed to try and get one of these entries here, right? It does take time. And for myself, this is one of the hardest trades. So what I usually do is if I miss the trend up, I won't short it. I'll wait till the inventory corrects, which we'll get to in a minute. Now, is everybody still with me on how this type of market structure is telling us, buddy, you don't want to short this, right? It's a very, very interesting way of looking at the market. Now, here's the rest of the day. So what this thing does is usually when we have a trend day up, in this F or G period here is when we will correct inventory. But we didn't do so until K. So what K did was it stopped the one-time framing up by taking the J low by more than 2 ticks. See, it took it by 1, 2, 3, 4, 5. But it couldn't take out that low. Then the next period in L couldn't get up and see we have a double top. When you said when I said there's a poor low that the sellers are trapped and there's no way out, here the buyers got trapped. So how you trade a structure like that is you're taking a short against that high and your stop is just above that high, right? And your first cover, right, is when L takes the K low, and then you look for the next cover here, right? Now you'll notice L could not take out the stops in H, and the price went right back up, right? So we can use these profile charts to tell us, oh, you know what? The buying ran out. Take a quick short, and if that short can take out the lower stops, then we can stay short because that tells us that we have supply. When it gets to a point where it can't take out a stop, that's where we buy back our short. Long, yeah, the stops from the longs. Yeah. Right. So we use the profile, right? How and where? Well, the stops are just at the bottom of every letter period. So let's go take a look. Okay. So if I looked at this profile, right, Jojo, where are your stops? Yeah, everything looks easy in hindsight, Sen, but you got to remember, I've been in front of these charts for 18 hours a day since 2012, right? So it's a matter of screen time. And trading is not something where you just back up a truck to the New York Stock Exchange and they fill it full of cash and you go home. You got to do the work. It's a craft. It takes time to craft. Brain surgery looks easy if you're at John Hopkins and you're watching somebody, who's the head of cardiothoracic surgery do a mitral valve replacement, right? He's going to make it look easy, right? I'm a day trader. I don't hold positions overnight, right? Trading is a craft. It's not something that you're going to luck into, make some Lamborghini money, and then retire. Those are just the YouTube videos. So, where are the stops? When you look at a market, the stops are the bottom of each letter period on the way up, right? So, do you see that, Jojo? Are you there? Jojo, where'd she go? Yeah, I don't hold because I mean this thing's only closed for 2 hours every day. So there's no reason for me to hold overnight. And they charge you so much margin. What's the point? I mean, I guess if you had like a 3,000 contract position and you were holding it for a couple of days or something, right? That's okay, no problem. She's back. Okay, so do you see? What about L, L, L? Oh, yeah, I forgot L. I'm sorry. Yeah. There. See now you see them, right? So at the low, what happens is now when this liquidation, when we came down, we took out that stop, that stop, that stop, and then L failed to take out the G stop, so we turned around and went right back up. So you guys kind of seeing how it slowly comes together? No problem. Now we have market profile 101 stuff in the market profile basics for the new members. Spend a little bit of time on that. I am going to try and do a simple market profile 101 video. I would really appreciate if I got some feedback from you folks on what is important to you and what you need to see. Fire away, Slot. Let's take some questions. If I use an FCM, okay, what is the purpose of the question, Slot? Are you trading like 10,000 mini contracts? What kind of size are you trading? Are you trading over 100 contracts on the E-mini? No, your order doesn't. What kind of size are you trading? If you're trading with anything less than, anything under 100 contracts, you're not. Nobody cares. I mean, I don't mean to be rude, but nobody cares. Don't even waste your time. You're just destroying brain cells for nothing. Nobody's front running your order. Even if you're trading 5 or 10 E-minis, nobody could give a that's nothing. Once you start trading over 100, 200, 300 contracts, that kind of thing, then you have to start worrying about those kinds of things. Now, single prints sometimes do get corrected, but only if there's supply on the way up. How do we get back down? Supply is going to have to build up over time and then cause the supply to break. Why is it called an inventory correction? That's what it's been called for the last 50 years, as far as I know. There was no such thing as an order book 50 years ago, Slot. And they're not repairing the order book. That would be completely, to say repairing the order book would be completely false and misleading. It's an inventory correction because inventory gets long or short and it corrects. It's that simple. It's really simple, man. Trading's been going around for 230 years. Just because we have computers doesn't mean that the business has changed. The business is still the same. I do not use phrases like buyers in control. I do not use that at all. I'm a pure order flow trader. I look at the interaction of order flow at a market profile level or one of my market profile levels or a piece of structure. I never use things like buyers in control, sellers in control, because that's completely inaccurate. Unfortunately, I know how the sausage is made. See, retail traders have a whole vocabulary of stuff, which 90% of it is wrong, because I don't even know where they got it from. Right? So that's why I don't use Bookmap is a waste of time. Unless you're trading 10,000 E-mini contracts, Bookmap is 100% waste of time. Because what that is for you to find liquidity to transact. If you're not trading 5,000, 10,000 E-mini contracts, you're wasting your time with Bookmap. Learn structure, it'll save you a lot of time. Today's RTH profile is not a P profile at all. It's more like a B. Why do you need to know where are you trading, Jojo, are you trading like over 300 E-mini contracts? Like what kind of contract size are you trading? You guys are worried about liquidity. No. That's you're wasting your efforts. I'm going to be very, very honest with you because so much of what you guys have been sold is a false bill of goods. Right? You don't need to worry about liquidity if you're a 5-10 contract trader. You need to know where the position is. Oh yeah, Bookmap is a complete waste of money. And I've seen really big discussions on whether that information that they're putting out is actually factually accurate. Right? If you get it free on Toss, you look at it. But you'd be well served to look at the profile, right? If you want to really figure out what's going on, right? Look to see where the buying is and where the selling is, right? Let's take a quick look at tonight's overnight. I'm going to go a little off book here, right? The market opened here, could not take out today's close. There's no selling. You don't need Bookmap to know that there's 50,000 contracts bid down here. Unless you've got 50,000 contracts to sell, you don't need Bookmap. What they do is they brainwash people with marketing, and it's completely false. I wouldn't tell you guys this if I have not traded $1 billion in order flow, billions and billions and billions of dollars in order flow over a 25 to 29 year period. I wouldn't be talking like this. FOBO? What's FOBO? Is that a stock symbol? Oh, FOBO. Okay. Right. There's lots of people out there who will take your money. And you can spend a lot of money on different types of software. right? Well, slot, that's great. Has no place in my room. I mean, I'm not going to argue with you. I don't know what your background is. I don't know what you're trading, but you're here with us. I'm trying to tell you because I'm pretty sure I've been trading a lot longer than you have. And Bookmap is an absolute waste of time. It's not going to tell you if there's a poor low or a poor high. It's not going to tell you if there's single prints. So I don't know what kind of market structure you're talking about. Simple. Let's move on. Anybody else have any other questions? Where do you get in? Where do you get out? Where do you put your stop? Why is the trade going to work? How do you manage your expectations when you're in the trade? That's all you need to know. The blue areas are the volume value area. The green areas are the areas outside of value. Inventory correction is a change in direction caused by too much supply or a lack of supply. Does that make sense? Like today, the market got too long. There was too much supply in the morning, and that's why we flushed and took out that B low. Yesterday's E period, this was an inside bar at an inventory correction. Exactly, Weave. Right? And it didn't stop the one time framing. Right? So that's a structural piece of information that tells us that we didn't have enough supply to take the D low. Right? Didn't have enough strength to take the D high either. So what happened was we got up here, we ran out of steam, the market auctioned down, found buyers here. Why? Because there were shorts here, right? So this is why we look at structure, right? So the shorts are trapped here. So we know that there's going to be buying at these areas because the more shorts are trapped, right, the more they're likely to buy at higher levels because they know that they're competing for product. San, I don't know what the order flow is going to be like tomorrow. I have no clue. I look at every day as a fresh piece of paper. I don't try and bias myself saying something's going to happen or it's not going to be because you're always surprised if you do that. Just try and keep an open mind when it comes to stuff like that. You know, it is month end, so there could be some hijinks. Just always, that's why we trade and use stops. Bias is tough. What I try and do, San, is if I'm biased, I'll call it out. Like I'll tell you guys, you know what? I'm short biased. Keep me in line, right? Like if you say it out loud, at least you put it out there that you could recognize that you're biased. What's my daily routine? Get up, look at the market. I'm looking at the market all the time because I usually trade that London Open at about 3 or 4 o'clock in the morning. So it's a little bit different than most others. Daily routine, I look at the overnight inventory. And if you're on the call with us on Zoom, we'll walk you through that half an hour pre market. So you're focused more on what's to form to the right. No, I look to the left, right, to see what's going to happen on the right, if that makes sense. On the stops, how do I know if they're long or short positions? Okay. So that M high, that's where the shorts had their stops. The M low is where the longs have their stops. I'm not going to look at charts right now, San. It's Market Profile 101. I'll do that on Thursday night if you want. If other traders are using iceberg orders, it means nothing to me. I could care less. Why? Because all I care about is if I want to go long, right? Watch this. Just pay attention for a little bit. Watch how that triangle acts when it gets to a price. Okay? It's at 86 and 3/4. This is the simplest, purest way of trading. It's been going on for 230, 300 years. When it gets down to 86 and a half, what did it do? Did it blow through it or did it jump up? You there? Yo, Slot. Okay. What did it do? It jumped up, right? So now, if it jumped up, is there a buyer there or a seller at 86 half? If the price came down to a level and couldn't hit it or jumped up before it got to it, thank you. There's a buyer there. Does that make sense? And that's trading. That's it. You watch how price acts when it gets to a level. You don't need to know if there's an iceberg or the Hindenburg or the Titanic or all that stuff there. You just watch how price reacts. Because before Bookmap, before Footprint, Noseprint, all of that stuff, there was a 15-minute delayed ticker, and you had a Gulf pencil and a pad of paper. Those are your tools. Go trade. How would you have traded before computers? It's not like the market was invented in 1987. People would have a price level, watch the reaction of that price at that level. It is the simplest, clearest way of this. So what you guys call order flow trading, which is another marketing scheme, right? Because the whole market is order flow. Buy orders flow in, sell orders flow in, and they transact, right? There's so much of this stuff is marketing. Just watch how prices react. It's very, very simple. People have been doing this for hundreds of years. And NL, if you're a swing trader, those iceberg orders aren't going to be there at night or the next day. Anybody knows who's ever moved a size position that those kinds of orders are used to push people around, right? Whatever you feel comfortable with. Swing trading the ES is a little tough because we have very, very large ranges, and your trade location has to be spot on. And so does your risk management. When you said there's a million orders coming towards your head, you can duck. When you see big orders coming, you mean close the trade or move the trailing stop. Like if you're long, Slot, could you give me like you're long and you see a lot of selling? Is that what you're trying to say? What's the biggest tip I could give a retail trader? Take your time. Take your time. Take your time. Trade and save your money until you know what the hell you're doing. Don't trade just for the hell of it. My job, the whole thing, the trick to retail trading is to keep your capital, hold on to your capital until you know what you're doing. That's the whole trick in retail trading. So you got to take your time, learn market structure, and learn a little bit how this business works. And it'll save you a lot of money. Also, remember, you got to learn before you earn. It's a skill. It's a highly specialized skill that takes time, discipline, right? And you have to have some mental endurance. You also have to have the ability to admit you're wrong. If you can admit you're wrong, it is going to be the biggest money saving thing that you could ever do. Right? There's a difference between conviction and stubbornness. Does that make sense? And be easy on yourself when you're learning, because it will take some time. You don't learn how to do brain surgery in one day, right? First, they got to show you where the brain is before they give you the saw, right? Right. Take your time. Any other questions? I'm very practical when it comes to this. We keep doing these every Tuesday night. Slot, you never answered the question. You could DM me if you want. I'll be happy to help. The one with inventory above, but we have no supply. Oh, because it takes time, Jojo. Let's take a quick look at where we are, right? Where are we in the zoo? Now look to the left of us. Is there any trading history here? Right? There's nothing, right? So there's nobody up here who has a cost basis to sell. So you have to take a couple of days to build up supply to have the market sell off. Yeah, that's stacking and pulling the taffy and whatever the hell they're doing. It's a complete and utter waste of time. I spent 25 years manipulating order books, Susan. The level 2, that was mine. Every single market maker reported to me. There's no way a retail trader would know that. Everything you see on a DOM is somebody painting a picture to make you think that you know what you're doing so we can take your money. All of that stuff is utterly useless. Yes, supply is sellers, yeah. Supply and demand, right? It's a market, right? Do I always ignore pending limit orders yet to be transacted? Yeah, I guess I do. Transactions are the only thing that matters, Slot. You ever heard the saying the tape never lies? The transactions don't lie. Profile doesn't lie. Everything else can be manipulated. Footprints are okay, but just don't forget where you are. Right? The profile will tell you where you are if you're in a place where you shouldn't be buying or you shouldn't be selling. Right? A lot of people will be looking at the DOM, and what I look at, the footprint, Susan, looking at a footprint without looking at a profile chart next to it is like driving a car and looking at the gas gauge and not out the window. You're going to hit a tree or somebody else. Footprints have their place. I don't teach it because it's a waste of time. What I like to do is I like to teach people how to make money trading. I like to teach them how to earn a living doing this. And human beings have about a 30-second attention span. So I try and teach them what they need to know quick and fast. Where's the supply? Is it above you? Is it below you? What's going on right now? Is the market adjusting inventory? What's going on? How do I take advantage of it? Or nothing's going on. I need to wait until something develops, right? Like you've heard of this thing called unfinished business on a footprint chart. The biggest incorrect information anyone could ever give you, right? So that's why I stay away from stuff like that. Keep it simple, right? Trading is a simple thing. What do I look at chart wise? Oh, I just look at structure, right? And I don't mind using a candlestick chart because a candle chart too will tell us agenda, right? Because our agenda on a candle chart is to buy a position. Down here, there's the inventory at the end of the day, and now it's being sold above VWAP. Once the buyers get tired of buying, we're going to come down to VWAP, flush the market out, clean it out, then take it back up. That's it. So that was Profile 101 and a little bit of more. But uh, I hope I answered all your questions. You know, you could DM me anytime, right? And use the resources. I'm going to try and redo or do a 101 profile sort of video that you guys could reference to. But stick with us on the Zooms wall and ask a lot of questions, right? Thanks, Slim. Have a great night. I'll have the recording up pretty soon here. Thanks, everyone. Have a great evening. If people have questions or anything, you're welcome to DM me. I will be around. It's minus 40. I am not going anywhere. Have a great night, everyone. Thank you so much. Yeah, DM me anytime, Slot. I'm always around. All right. Have a great night. Thank you so much. Bye for now.